The simple retirement portfolio that's almost impossible to beat. You're sitting at your kitchen table at 11 p.m., 17 browser tabs open. One says, 3 stocks about to explode. Another says, why bonds are dead. A third is a 45-minute video about some guy's secret sector rotation strategy that supposedly turned $10,000 to $1 million. You have a 401k somewhere. Maybe a Roth IRA you opened 3 years ago and haven't touched since. You know you're supposed to be doing something with your money. You just don't know what. So you keep researching and researching. And somehow, the more you learn, the more confused you get. Here's the strange part. Somewhere out there right now is a person your exact same age, making your exact same salary, who spends about 11 minutes a year thinking about their investments. Not because they don't care, because they figured something out that you haven't yet. And here's what I eventually figured out too. I'm not a financial advisor. I want to say that up front because I used to think you needed to be one to understand this stuff. For years, I did the same thing you might be doing right now. I chased returns. I moved money around every time some headline scared me. I once sold a fund at a loss because a guy on the internet said a correction was coming and then watched it climb 30% over the next year without me in it. I lost money being smart, or at least being what I thought was smart. What finally worked for me wasn't a secret. It wasn't a stock tip. It was almost embarrassingly simple. And once I saw it, I couldn't unsee it. Let's talk about 2 people. We'll call them Mike and Denise. Both are 38. Both live in Ohio. Both make about $68,000 a year. Both have access to a 401k with a 4% employer match. On paper, they're the same person. Mike is what you call financially engaged. He reads investing forums during lunch. He has 4 brokerage apps on his phone. He moved his 401k into a growth-focused, actively managed fund in 2019 because it had beaten the market the year before. He switched again in 2022 when that fund cooled off. He's currently deciding between a dividend fund, a tech-heavy ETF, and something his coworker mentioned called a leveraged index fund. Denise, on the other hand, picked one simple portfolio 9 years ago: a total US stock market index fund, a total international index fund, and a bond index fund. She set her contribution percentage once. She rebalances once a year in January, and it takes her about 10 minutes. She has genuinely never looked up what a sector rotation is. Same income, same starting point. Very different paths. Think of it like this. Mike is driving a car that needs constant attention. Something's always being tuned, swapped, upgraded. It's loud, it's exciting, and it spends a lot of time in the shop. Denise is driving an old Toyota Corolla. Nobody's ever made a movie about a Corolla. It's not exciting. It just starts every single morning and keeps going year after year while everyone else is dealing with breakdowns. That's the whole video, really. The Corolla versus the car that's always in the shop. Level 1 is about removing the fear that simple means not enough. A lot of people assume that a basic portfolio, a few index funds, held steady for decades, is what you do if you don't know what you're doing. That the real investors, the smart ones, are doing something more complicated. It's actually closer to the opposite. The S&P Dow Jones Indices SPIVA Scorecard tracks this every year. It compares professional, actively managed funds, run by people with finance degrees and Bloomberg terminals and teams of analysts, against a simple index. Over a 15-year period, roughly 9 out of 10 of those professionally managed funds failed to beat their benchmark. Read that again. 9 out of 10 professionals doing this full-time could not consistently beat the boring index. That's level 1. The Corolla isn't the beginner's choice. The Corolla is what most of the experts secretly can't outperform. Level 2 is about why simple actually works mechanically. A simple 3-fund portfolio, a US total stock market fund, an international stock fund, and a bond fund, does one thing very well. It owns a tiny slice of thousands of companies at once instead of betting on a handful of them. When you own one stock, or even 10, you're betting on those specific companies surviving and thriving over 30 years. When you own the whole market through an index fund, you're betting on American and global businesses collectively, continuing to grow the way they have for the last 100 years. One of those bets requires you to be right. The other just requires the economy to keep doing what economies do. The bond piece isn't there to make you rich. It's there so that when the stock market drops 30%, you're not forced to sell stocks at the worst possible moment just to pay your bills. It's the shock absorber. The Corolla doesn't need to be fast. It needs to not break down when the road gets rough. Level 3 is where we apply this to your actual accounts. For most people, this plays out across 3 buckets. Your 401k, through work, where that employer match is free money you should never leave on the table. A Roth IRA, where your money grows completely tax-free and you never pay taxes on it again once it's in retirement. And later on, Social Security, which was never designed to be your whole retirement, just a floor underneath it. Denise puts her 401k contribution at least up to her full match. Then she funds her Roth IRA. Inside both accounts, it's the same simple mix: a total stock index fund, a total international index fund, a bond fund, adjusted to get more conservative as she ages. No stock picking, no trying to guess what sector will boom next. No account she's afraid to open her statements on. Mike also has a 401k and a Roth IRA. But inside them is a rotating cast of funds he's constantly reevaluating. Same accounts, completely different experience. Let's put real numbers on this. Say both Mike and Denise contribute $500 a month, starting at 38, and get that same 4% employer match. Denise stays invested in her simple portfolio the whole time, averaging a historically reasonable 8% annual return. Year one, $6,000 contributed grows to about $6,400. Not exciting yet. Stay with me. By year 10, roughly $86,000 in the account. By year 20, roughly $275,000. By year 30, at age 68, roughly $735,000. Let that sink in. Nearly $750,000 built from an account that took 10 minutes a year to manage. Now here's Mike's version. He contributes the same amount, but because he keeps jumping between funds, chasing whatever performed well last year and selling whatever just underperformed, real data from Fidelity shows what that pattern actually costs. In a recent multi-year stretch of market volatility, savers who stayed invested and kept contributing ended up with 45% more money than savers who pulled out of stocks during the scary moments, even though both groups kept contributing the whole time. Think about that for a moment. Same contributions, same years. A 45% gap just from behavior. Mike's version of that 735,000 outcome might realistically land closer to $500,000 once you account for the funds he sold at losses, the fees on the actively managed options he chased, and the months he sat in cash, waiting for things to calm down. That's not a small difference. That's the difference between retiring at 65 and working until 70. That's the difference between a comfortable retirement and a stressful one. Here's what nobody talks about. The financial industry does not make money when you do nothing. It makes money when you trade, when you subscribe to premium research, when you pay a 1% management fee for someone to actively pick investments for you. So an enormous amount of the content you see about investing is, whether intentionally or not, designed to make you feel like simple isn't enough, that you need the newsletter, the alert system, the hot sector, the next Tesla before it's the next Tesla. But the research keeps saying the same thing, year after year, decade after decade. The single biggest predictor of long-term investment success isn't which fund you pick. It's whether you stay invested and leave it alone. The Corolla wins not because it's clever. It wins because it doesn't tempt you to keep opening the hood. But how do you actually survive this emotionally? Because watching your account drop 20% and doing nothing about it feels almost unnatural. I think the honest answer is that you have to change what you're optimizing for. You're not trying to make the smartest trade this month. You're trying to still be invested calmly in 25 years. A few things that actually help. First, automate everything you can. If the contribution happens before you see the money, you never have to rely on willpower. Second, check your accounts far less often. Checking daily shows you noise. Checking annually shows you a trend line that, for a simple diversified portfolio, has gone up over every 20-year period in US history. Third, when you feel the urge to do something during a scary headline, write down what you're afraid of and revisit it in 30 days. Almost every time, the fear fades and the market has already moved on without you. If you're feeling behind right now, you are absolutely not alone. Fidelity's own data on millions of retirement accounts shows a wide range of balances at every age, and plenty of people in their 40s and 50s are still building from a modest starting point. Behind isn't the same as broken. It just means you start today instead of yesterday. If you're in your 30s or early 40s, your biggest advantage is time, not money. One action step. Open or increase your Roth IRA contribution this month, even by $50. One mindset shift. You don't need a perfect portfolio. You need a boring one you'll actually keep. If you're in your 50s, you still have 10 to 15 working years, which is a real amount of compounding time left. One action step. Use the higher catch-up contribution limits now available to you under current IRS rules. One mindset shift. This is the decade to simplify, not to get more aggressive or clever. If you're in your 60s or a late starter, Social Security and Medicare timing decisions matter more than any single investment choice right now. One action step: get a real handle on your expected Social Security benefit and your Medicare enrollment window before you touch anything else. One mindset shift: a simple, low-maintenance portfolio protects you from making a costly mistake during the years you can least afford one. Somewhere along the way, a lot of us started believing that a good financial life has to look complicated to be taken seriously. That boring means you're missing out. But the Corolla was never the boring choice. It was the choice that let everyone else's flashy car break down in the rearview mirror while it just kept driving. You don't need to predict the market. You don't need to find the next big stock. You need a handful of simple, low-cost, diversified funds, a contribution you barely think about, and the patience to leave it alone for a very long time. That's it. That's the whole strategy that's almost impossible to beat. If this helped you see your own accounts a little differently, it might help someone else you know who's stuck in those 17 browser tabs too. And if you want more of this simple, no hype retirement thinking, you know where to find me.